If you are 60, 65, or 70 and you just crossed $1 million in retirement savings, let me say something that sounds wrong at first. That number does not mean you are safe. Not in America, not in a traditional 401k, and definitely not if you are getting close to age 73. Because a retiree with $1 million in a traditional IRA or 401k can be forced to withdraw about $37,736 in the first year required minimum distributions begin. That is not an opinion, that is IRS math. The Uniform Lifetime Table uses a divisor of 26.5 at age 73. 1 million divided by 26.5. That is the number. And once that forced income hits, three things can happen fast. Your taxes can rise, more of your Social Security can become taxable, and your Medicare premiums can jump, even though you did nothing wrong. That is the part most people never hear when they are chasing the $1 million milestone. They hear, if you have $1 million, you can pull 4% and live on $40,000 a year. What they do not hear is what happens when that money is sitting in the wrong account, at the wrong age, under the wrong tax rules. So in this video, I want to show you the 3 retirement traps that hit many million-dollar savers after retirement, the one planning window that can save tens of thousands in lifetime taxes, and the specific moves that matter before the IRS starts making decisions for you. Stay with me, because reaching $1 million is not the finish line. For a lot of retirees, it is the moment the real planning begins. Number 1. The illusion. Why $1 million does not automatically mean $40,000 of freedom. Let's start with the myth. Most people have heard some version of the 4% rule. You have $1 million, you withdraw 4%, that gives you $40,000 a year. Clean, simple, reassuring. But retirement is not lived on gross numbers. It is lived on after-tax cash flow. Take a simple example. A 68-year-old single retiree receives $2,100 a month from Social Security. That is $25,200 a year. She adds $40,000 from a traditional IRA. On paper, that looks like $65,200 of income. But now the tax rules start working. Under IRS rules, the taxable portion of Social Security is based on combined income, which is basically half of your Social Security benefits plus other taxable income plus tax-exempt interest. Once that number goes above $25,000 for a single filer, up to 50% of benefits can become taxable. Once it goes above $34,000, up to 85% of benefits can become taxable. So now, her $40,000 withdrawal is not arriving in a vacuum. It is dragging more of her Social Security into the tax system. And in 2026, the standard deduction for a single filer is $16,100. On top of that, many seniors may qualify for an additional $6,000 senior deduction, depending on income and eligibility. That helps, but it does not erase the fact that the withdrawal is still creating taxable pressure. This is why 2 retirees can both have $1 million, and one feels comfortable while the other feels squeezed. Same balance, different account type, different age, different tax result. That is the first mindset shift. $1 million is not a lifestyle number, it is a tax behavior number. And that becomes painfully obvious when the IRS clock runs out. Because the real problem is not the money you choose to withdraw. It is the money the government eventually forces you to withdraw. Before we continue, please show some free love and support by hitting the like button and let me know your opinion, thoughts, or any questions if you have. I reply every single comment and I would be very happy to help, because this channel is built specifically to help retirees. Now, let's move on. Trap number 1. RMDs take the wheel at 73. Under current IRS rules, most retirees must begin required minimum distributions, RMDs, at age 73. For IRAs, your first RMD is generally due by April 1 of the year after the year you turn 73. After that, each year's RMD is due by December 31. Now here is where people get blindsided. If your traditional IRA or 401k is worth $1 million at the end of the prior year and you are 73, the divisor is 26.5. That produces a required withdrawal of $37,736. You do not get to say, I do not need the money this year. You do not get to say, the market is down, I would rather wait. You do not get to say, I want it, leave it invested. The IRS does not care. And if you miss that withdrawal, the penalty can be brutal. The excise tax is 25% of the amount not taken. If corrected within 2 years, it may drop to 10%, but either way, it is an avoidable mistake that can cost real money. Now, watch what happens over time. At age 74, the divisor falls to 25.5. At 75, it falls to 24.6. The denominator keeps shrinking, which means the forced withdrawal percentage keeps rising. That means a retiree who started with a $37,736 RMD at 73 could be looking at a higher required withdrawal later, even if they never wanted to increase spending. And here's the counterintuitive part. Many retirees think, well, I'll be taking money out, so the account should naturally get smaller, and the RMD should shrink. Not necessarily. If a balanced portfolio grows at 5 to 6% a year, early RMDs can be partially offset by market growth, so the account does not always fall quickly. In some cases, the forced dollar amount stays flat or even rises for years. That means more taxable income, more pressure on Social Security taxation, and more risk of triggering the next trap. And if you are between 60 and 72, I want you to keep listening closely, because the most valuable years in this entire video are the years before these withdrawals begin. Trap number 2. Medicare IRMAA, the surcharge most retirees never see coming. Now let's talk about the bill that shocks a lot of savers. Medicare IRMAA. That stands for Income-Related Monthly Adjustment Amount. In plain English, if your income is high enough, Medicare charges you more for the same coverage. In 2026, the standard Medicare Part B premium is $202.90 per month. The Part B annual deductible is $283.93. But once income crosses certain thresholds, the price changes. For a single filer, the first IRMAA line begins above $109,000 of modified adjusted gross income. For a married couple filing jointly, it begins above $218,000. And the first surcharge is not tiny. The first IRMAA tier adds $81.20 per month to Part B. That brings the monthly premium from $202.90 to $284.10. On top of that, Part D adds another $14.50 per month. So a retiree who barely crosses the first IRMAA threshold can end up paying roughly $95.70 more every month, or about $1,148 a year, for basically the same Medicare coverage. Now think about a real scenario. A married retired couple, both 73, has $42,000 in combined Social Security, a $37,736 RMD from one IRA, another $18,000 from a pension, and $9,000 in interest and dividends. Now they are around $106,736 before even talking about how much of Social Security becomes taxable. Add a modest capital gain, or a larger IRA withdrawal, or a home sale with extra taxable income, and suddenly they are much closer to an IRMAA threshold than they expected. And here is the part almost nobody explains clearly. Medicare usually looks back 2 years, so your 2026 Medicare premiums are generally based on your 2024 tax return. That means one big income spike, a Roth conversion, the sale of appreciated investments, a bonus payout, a large traditional IRA withdrawal, or a home sale with extra taxable income, and suddenly they are much closer to an IRMAA threshold than they expected. This is why retirees say, "My income went back down. Why am I still paying more?" Because Medicare is looking in the rearview mirror. That lag can punish people who never saw it coming. So, if RMDs can force income into your return, and higher income can make Social Security more taxable, and that same income can raise your Medicare premiums, then the most valuable move in retirement is not random tax saving, it is timing. Number 2, the window. Ages 60 to 72 can be the golden tax years. This is where the whole picture changes. For many retirees, the years between retirement and age 73 are the most underused planning years of their lives. Why? Because wages may have stopped, Social Security may not have started yet, and RMDs have not begun. That can create a temporary stretch where taxable income is lower than it has been in decades. And that is where Roth conversions become powerful. A Roth conversion means moving money from a traditional IRA into a Roth IRA and paying tax on the amount converted now instead of later. The reason retirees do this is simple. Money inside the Roth can grow tax-free. Qualified withdrawals are generally tax-free, and Roth IRAs do not require RMDs during the original owner's lifetime. That last point matters more than most people realize. Let's use a specific case. A recently retired couple, both 64, has $1,050,000 in traditional IRAs and $120,000 in a Roth IRA. They have not started Social Security yet. Their part-time consulting income is gone. Their taxable income for the year is unusually low. In 2026, the standard deduction for married filing jointly is $32,200. The 12% bracket goes up to $24,800 of taxable income, and the 22% bracket begins above $108,800 of taxable income. So instead of waiting until 73 and being forced into withdrawals later, this couple may choose to convert, for example, $60,000 to $90,000 a year during low-income years, carefully watching both tax brackets and future Medicare effects. If they convert $75,000 a year for 6 years, that is $450,000 moved out of future RMD territory. Now imagine what that can do. Instead of reaching 73 with $1 million still sitting in tax-deferred accounts, maybe they arrive with $600,000 to $700,000, depending on market performance and how much was converted. That can materially reduce future RMDs. It can reduce future taxable income pressure. It can make IRMAA planning easier. And it can create a pool of tax-free money for later retirement years. This is why I say the years before 73 are not quiet years, they are decision years. And every year you delay, the window gets smaller. At age 67, you may still have 6 years. At 70, maybe 3 years. At 72, you may be nearly out of room. That is not marketing urgency, that is calendar math.
Number 3, the hidden tool. QCDs can turn charity into a tax strategy. Now let's talk about one of the most underused moves in retirement planning, the Qualified Charitable Distribution, or QCD. If you are 70 and a half or older and you have a traditional IRA, you may be able to send money directly from that IRA to a qualified charity. And in 2026, the annual QCD limit is $111,000 per person. Here is why that matters. A QCD can count toward your RMD, but it does not get included in your taxable income the same way a normal IRA withdrawal would. That is a huge difference. Let's say you're 74 and your RMD is $38,500. You already give $10,000 a year to your church, your mosque, a scholarship fund, or a local food bank. If you write that check from your checking account after taking your full RMD, your tax return still shows the full IRA income first. But if $10,000 of that amount goes directly from the IRA custodian to the qualified charity, then that $10,000 can satisfy part of the RMD without first showing up as taxable income. That can help reduce adjusted gross income. It can help reduce the taxation of Social Security. It can help keep you below an IRMAA threshold. That is not a loophole. That is a rule. And one important detail matters here. A QCD must come from a traditional IRA. It does not work directly from a 401k the same way. And the money must go directly from the IRA custodian to the qualified charity. If the money comes to you first and then you donate it, that is generally not the same tax result. For retirees who already give, this is one of the cleanest tax moves available.
So here is what I would do if I have $1 million in retirement savings right now. First, log in to every traditional IRA and 401k account you have and write down the balances. Then divide the total by 26.5. That gives you a rough idea of your first-year RMD at 73, based on today's balance. Second, if you are between 60 and 72, pull out your latest tax return and look at your taxable income. If this is a lower income year, ask what room you have for a partial Roth conversion before you spill into a higher bracket or future Medicare trouble. Third, if you are already 70 and a half or older and you give to charity, ask your IRA custodian specifically about a QCD before year-end. Fourth, if you are close to Medicare thresholds, stop thinking only about this year. Start thinking in 2-year windows, because Medicare often does. And fifth, if nobody has projected your future RMDs, IRMAA, exposure, and Social Security taxation together on one page, then you are not looking at retirement income planning. You are looking at fragments. Reaching $1 million in retirement savings is a real achievement. Most people never do it. It takes discipline, it takes decades, it takes sacrifice. But the statement balance is not the whole story. What matters is where that money sits, when you touch it, and what the tax system does when you don't plan ahead. Because $1 million in the wrong place can create forced withdrawals at 73, make up to 85% of Social Security taxable, and push Medicare premiums higher than they need to be. So no, the million is not meaningless. It is powerful, but it does not buy safety by itself. What it really buys is options, and in retirement, options only help the people who use them before the window closes. Now, if you have any opinions or questions, drop it in the comments below. I would love to help you as soon as possible. If you want more retirement money content like this, subscribe. And if you want to go deeper on how having a pension in retirement changes everything, click on the left video. And if you want to know about the retirement sweet spot, where you can stop contributing to 401k and still grow your account, click on the right video. Whichever you choose, I'll see you there.